In exercise 8-8, we're going to learn how to go past just posting accounts receivable from selling an item and then collecting it. We're going to look at what happens when a customer defaults on their payment, and then how we reinstate them when they surprise us and they all of a sudden pay, and then also how to record bad debt expense. And in this case, we're going to use the accounts receivable method. So let's just give this a quick read. Outdoor Equipment sells camping equipment. On December 1st, the accounts receivable count had a balance of $50,000. So it's really good to keep T accounts for these types of questions, even if it doesn't ask you to do it. But we're going to go ahead and put that $50,000 balance, which they already did, into accounts receivable. And then it says the bad debt expense account had a balance of 0. So I'll just check to make sure that's true. So that's right there. And that makes sense because usually we don't record bad debt expense until the fiscal year. And the allowance for doubtful accounts had a credit balance of $5,000. And that's the balance right there. Now, I just want to warn you that sometimes allowance for doubtful accounts could have a debit balance, but they'll tell us. So when we put accounts receivable onto the balance sheet, what we do is we take whatever's in the accounts receivable account, and then we add or subtract whatever's in the allowance for doubtful account. And then that net amount shows up as accounts receivable. And then the bad debt expense shows up on the income statement. So it says the remaining journal entries for the 2020 year were as follows. So the first journal entry is sold tents for $5,000 on account. So that means accounts receivable with a cost of $2,500. So again, we have to do this double journal entry. So December 2nd, we're going to do accounts receivable, $5,000, and sales, $5,000. And if we knew who it was to, we could put the accounts receivable and then the name, but they didn't tell us who that was. And then I'm going to record the cost of the sale. So again, it's just cost of goods sold, and then take it out of your inventory. And that's for the $2,500. And let's just double check that. And what I'm going to do is I'm going to post in the T accounts every time I make a journal entry. So whenever it hits accounts receivable or allowance for doubtful accounts or bad expense, I'm going to put that in there. So December 2nd, I'm going to put that 5,000 accounts receivable in here. There we go. Make sure I have enough zeros. Okay, now record the write-off of uncollectible account for Rocky and Grouse Company separately. So let's see here. It says on December 20th, determined that the total accounts of Rocky with an accounts receivable balance of $1,200 and Grouse with an accounts receivable balance of $2,500 were uncollectible and need to be written off. So when we say we're writing off an account, we're just deciding that we're just tired of trying to collect money from them. So we move them out of accounts receivable into this sort of holding account, which is called the allowance for doubtful accounts. So I'm going to move it out by making a credit in this account, and then just move it over by making a debit to that account. So that's what this journal entry is going to do. So I'll just total the two together when I do the debit for the allowance doubtful accounts. But let's see what these accounts receivables are. Accounts receivable Rocky, and that amount was $1,200. And then I have accounts receivable Grouse, and that was $2,500. So when we add those two accounts up now that we're writing off, that comes to $3,700. So now I'm going to make 3 T account adjustments. So the allowance for doubtful accounts of $3,700, we're going to put over here. and that was December 20th. And then the accounts receivable, it's the 1,200 and the 2,500. And that was the 20th as well. So see what I did? I just moved these two guys over into this account, and we don't touch bad debt expense until the end of the fiscal year. So we just dealt with the write-off. And then it says record the reinstatement of gross Inc. So let's just see what it says. Unexpectedly received payment from Grouse Company for $2,500. So the original amount that we wrote off was $2,500. So sometimes they can pay all of it. Sometimes they might pay just a bit of it. So what we're going to do is put it back into accounts receivable and then make the payment on it. So that's for the 23rd. So this is me putting it back into accounts receivable. Accounts receivable, 2,500, and then allowance for doubtful accounts, 2,500. So if we look at what this journal entry looks like here, so that's what, December 23rd? And that was 2,500. So that's going back in here. And now let's take it back out of here. So December 23rd. 2,500. And I think they actually, not sure if they want us to like just keep on the same lines. We'll see how that works out for me in the end. But let's see here. So that's 2,500. And then we're now going to receive the cash from it. So cash, 2,500, and accounts receivable. So these are always the steps that you do. You don't just take it straight out of allowance for doubtful accounts and pay the cash with it. We're going to move it back into accounts receivable properly and then receive the payment. So it's a two-step entry. So cash and accounts receivable. And let's go ahead and post that one. So accounts receivable on the 23rd is going to come out again. Right? So if you see kind of the progression of that 2,500, it was so we took it out and put it in here, and then when we reinstated it, we took it back out of here and then put it back into accounts receivable, and then when they paid it, we took it out again. So it was like in and out and in and out and then in and out. Crazy. Okay, so let's record that entry. And then record the estimate for uncollectible accounts. And they say the way that we do that is, let's see here. I need to find that. Okay, I should just learn to read what's right in front of me. So it says on December 31st, estimated that 10% of the accounts receivable recorded to date would be uncollectible. So what they mean is, I'm just going to take a snapshot of this and then move it into my OneNote, and then I'll show you how to make that calculation because it's pretty important. Okay, so when they say 10%, what we're doing is we're taking the balance of 51,300. So what that is the 50 plus the 5 plus the 25 minus the 12 minus the 25 and minus the 25. So you get 51,300 and you multiply that by the 10%. So then that will give me 5130. So that's what I want. So under the accounts receivable method, this means that I want my allowance for doubtful accounts to be 5130. So this isn't the journal entry. So then what we have to do is figure out, okay, what in this account do we either have to debit or credit to bring it from 3,800 to 5,130. So let's just take the difference. So 5,130 and 3,800 will give me, just put it in my calculator, it gives me a difference of 1,330. And the difference, I know I have to credit it, is because it's already at 3,800. So without this 1,330 in here, then that will bring that to 5,130. So let's go ahead and do that adjusting journal entry. And what that will do is means that we're going to bring it over here too. We're going to put it right over here as bad debt expense. So my debit will be bad debt expense, and my credit will be allowance for doubtful accounts for 1,330. But I just warn you, if we do this calculation and sometimes we need to decrease our allowance for doubtful accounts, then you'll find you'll be doing a debit to allowance for doubtful accounts and a credit to bad debt expense. So you might see another question doing it that way, and that's the reasoning behind that. Okay, so let's just go ahead and journalize it in here. So bad debt expense for the 1,330, and then my allowance for doubtful accounts of 1,330. And let's go ahead and put these entries in here. So December 31st is 1,330. And then my bad debt expense for December 31st is 1,330. Now, one more thing that I want to show you before I let you go is if they ask me what the accounts receivable looks like on the balance sheet, what we would do is we would take this 51,300 and then subtract your allowance for doubtful accounts. And now sometimes when we shorten this, we call it allowance for doubtful accounts. I'll just put that here, allowance for doubtful accounts. So we'll subtract out that 5,130. So this is called a contra asset account because it belongs with your receivables. And so now my net receivables is the difference. So 51,300 minus 5,130. So that's 46,170. So this amount is going to show up on my balance sheet. And I usually just say BS to show that this is going to the balance sheet. And we're done.